Hello and welcome everyone to the weekly Delphian meeting. Thank you for tuning in. So today's agenda will be pretty brief, nothing with earnings, but we'll do our market update and then have Joe's analysis, but should be a pretty quick one. Um, so let's get started. I did want to point out we do have a couple of changes that we've been making in the platform. We reorganized the analytics tab, so like Delphian analysis and now symbol analysis. Um, in there, we also have this new seasonality page, which is pretty cool graphic. So this goes back to '07, gives you like the monthly average, month by month returns and things like that. So we also reinstituted our ETF exposure. So we had some data issues, but now that's all fixed. So this is also available in the platform. So that's just a quick update. All right, so markets overall, indices all in one. You can see here, making pretty strong moves overall. Pi wise 59, basically 60% last week, so up around 70 now. And then, state ones we've been making 52-week highs, the past couple of days here. So definitely at this point overbought, well above the 45% level. So same thing, sectors, no changes from last week. We get energy in 8 and everything else in 1. So yeah, let's look at the charts here. So you can see, 1 year high here. Definitely, an overbought condition. If we can hold above there, then we can keep grinding. But there's not much else as far as twos. We're at 4%, so not a lot can go into 1 from there. Same thing with like fours, down there like 3-4%. So not a lot that can move. We are seeing some sevens move from 8 to 7, so up around 9% there, which is bullish overall. See those 8s drop down, but it, from 7, it'll have to go either 3 or 5 and then 1. But definitely, it's been bullish since the Fed. Um, Pretty much last 2 weeks ago, the 11th here, you can see, this thing's climbing higher and all-time highs, and the new highs, lows, still just cranking out the greens here. So obviously that's bullish. We've just been getting this kind of 1-2, 1-2 action, and we get these little pullbacks like here, and then kind of resume. So it's kind of where we're at. All of these moving averages are well above. The aboves are well above the belows. So, and that's it. Let's look at the bullish bearish here. So we are getting kind of, that typical range, around 70, where, kind of topish. Obviously back here, we got well above there in the 80s. But, this is kind of like typical patterns where it goes up and down, up and down. This is kind of atypical, but you can see here back and forth, back and forth. So, if we look at the bullish, so that's the 52-week highs, 84. So not quite, in that neighborhood, but in that kind of range where things, we start, kind of have to look for pullbacks. But, that's kind of where we're at. The other things, so SPX, they won, so we had a nice bounce off, 5,400, which is the bottom of the range, and just took off from there. Top of the range 58. So now we are getting into That resistance level 1, 2, where we typically see, things kind of roll over and pull back. If we get through there, then, obviously we can make a run towards T3, but, this kind of, that near-term resistance. Um, and right above there is the top of the range, 5,800. So, so to the upside, we got the target 1, 2 range, 5,800 as the top. And then pretty much nothing down below except for, the entry price, 55. And then, up, well below that, the bottom of the range, 5,400. So, it's starting to show some little bit of resistance here, kind of like we saw back here when we saw a pullback. So, if we can, continue making highs at the close, that's very, very strong. Um, but I would expect that, pretty stiff resistance right in this range, target 1, target 2. So, okay, let's look at the chart here. So, well above 20-day, that's 56. The 50 days pretty much right near that entry price, 55.40. So entry price 55.55. So kind of same range, but so there's your low, support levels. And then to the upside, we got our modeling for target 1, 2, and then, top of the range, 5,800. Bottom here is 54. So, if we're, above, these moving averages and, we're making highs, we get all the green on the new highs, new lows. It's just generally bullish overall. So, I think the big thing is holding, this 20-day EMA stand above there, 56.12. So, and I think we're well about 100 points above that right now. So that's where we're at there. And then, Russell, kind of same, story, getting up in that 1, 2 resistance range, 2269 to 2283. Top of the range would be 23, bottom's 21. So, just see if we can stay, break above those, get in there. But, the typical pattern, may clear this. Uh, as we run up here, pull back, and then kind of go like that. So that's typical pattern. So, downside support, 21, entry price 21.89. I would say even more important that staying above 2,200. Like every 100 on the Russell's kind of support and resistance. So staying above 22 would be, encouraging overall for the Russell, and then stay above there. See if we can make a run above, target 1, 2, get into that kind of average range, which is about 5.8%. So we're only 7 days into 35. So that's Russell there. So look at the chart. 50 days, 21.54. So really, I think staying above, like I said, that 22 right here, I think that's crucial. Top of the range would be 23, and then bottom range 21. So you got that high, that 2,300 back here. Let me see. Just touched it and everything, just went bad real quick. So staying above here, 22, if we can hold that, I'd expect things to, make another run at 2,300, get through that target 1, 2, but, we'll have to see, a lot of, things are, as far as market pulse are getting a little hot, a little overcooked, I would say, but And, just based off of getting into the target 1-2 range for both Russell and SPX. Yeah, just be a little careful near term. But, if this follows a typical pattern, we'd stay above that entry price, which would probably be right around 22, that kind of range. So we're right on that now. So, if we can hold above that, I'd expect things, turn back north. If it breaks, then, we'll have to wait and see. So, 10-year, pretty much pegged right around 375. Not a ton of action. You would expect with a big cut, uh, things to move more, but pretty much nothing, as far as, 10-year. So, but this is all driven off of, the treasury market, so bids and things like that. So, but, I think it's, we get drops in those rates. It's definitely good for, especially Russell market overall too. But well, let's talk Fed. I was wrong. I thought they were going to be conservative last week with a quarter, and it went 50. So it was interesting. Didn't expect that. So as far as next, this is what 40 days. This is right after election. Definitely moving more towards aggressive. This would be we're at 475 to 5. So, moving more towards more cuts. So this would be another 50. Definitely still kind of in the coin toss range, but we'll track and see. But definitely, they're getting more aggressive with their expectations. So I think it'll be data dependent too. We got some inflation stuff on Friday, and then next week we got unemployment. So, and then this is year end, last one in December. So pretty much right, this would be 75 drop from where we are at. So it'd be a 50 and a quarter. So they're expecting them to be pretty aggressive with these cuts, and I'm not too sure about that, but I think it'll be data dependent. So and then Fed balance sheet, they're not doing anything. It's pretty much flatlined. So that's pretty much neutral for the market. It's not like they're easing, which is definitely tailwind for the markets, and then tightening's typically a headwind, but they're pretty much doing nothing right now. Maybe a little bit of turnover. So we'll see if this balance sheet, what happens with it, but so far pretty much nothing. So all right, I think that's it. I didn't have any cool charts or anything. Open up to questions, comments on market overall.
Oh, hey Josh, Dan here.
Hey, Dan.
Um, yeah, I like the improvements that are going on with the site.
Mhm.
What was the second thing that you talked about where it showed the average monthly percentage gain with all the different
Yeah, so that's in a symbol analysis.
oh, symbol now. Okay.
Yeah, so and you just type it in, it gives you the seasonality. So this is month over month return since '07, and then we average them up top. So that's the general
Oh,
average.
oh, cool.
Yeah, so it's every symbol in the system, all 4,000 something. They all
Okay.
have their own data. The other thing was the ETF exposure. We fixed all the data here, so we started pushing it out again, in case people like that. But
Yeah,
yeah,
yeah. The way the market's been going over the past year, I feel like we're living back in the roaring 20s again. It just seems to be going up and up and up.
you were
And
alive then.
yeah, well,
Never,
almost.
never read about it. Joe,
Almost.
you remember
Yeah.
those days, right, Joe? I'm joking.
Hell yeah, Josh.
Roaring
Yeah.
20s.
Every time I'm waiting for a big correction that never comes. I feel like I'm waiting for the bus that never shows up at the bus station, but every time I think we're gonna, you hear about the volatility coming into the election and all this stuff, and then China all of a sudden starts turning on the printing presses, which is supposed to be positive and inflationary. So
Mhm.
I think where's more volatility? It just
Yeah,
it just seems to be people are just complacent. I don't know. Um,
yeah.
but
Well, I mean, I would, they're, the Fed's kind of turned to more,
and
restrictive, less
and that's the
restrictive.
other thing. I mean,
Yeah.
to me, 5.25%. I remember back in the '80s when hell you could get 16%,
Hmm.
in your bank, you know. Um, so to me, 5% wasn't really that much, but today it seems
Yeah.
to be a different ball game. It's like a lot. Everybody's making a big deal out of it, and with
We were at zero for a real long time.
yeah, oh yeah, yeah, and that's great if you're getting a loan on a new car or something, but yeah, I don't know. It's just um, where would you go on this site if you want to get a broad overview of international markets? Is there a place that you can go to kind of
Um,
bring things together?
yeah, and I mean, you you could, I think, you just want to look at the different ETFs that track, like, international, like there's FXI, I think it's China. You just have to look at them individually. We
Just
haven't
bring them up
built
individually.
anything.
Yeah.
Yeah,
Yeah.
just like emerging markets. So that's, China and a bunch of other. I
Oh,
don't know.
okay.
I don't know how China's technically an emerging market at this point, but um, this is like Europe. So yeah, there's a bunch of, different
Is it is
ETFs that
is the
track
Hang
all.
Seng on there?
We don't have the index, but
No,
I
no.
would, yeah, I'd just pull up. I think it's FXI is like China. Like we have a ton of ETFs in here, so. That's a
Okay.
large cap China. Wow, that's a big move for September.
Yeah, yeah.
I haven't looked at that one in a long time. Let's take a quick look.
Yeah, this is Dave. I
I
want
do.
to throw a comment back at Dan there with your comment about where would we think about the market. When you said that, it made me think real hard about what the market is actually a collection of a whole bunch of other sub-markets, and they each have their own story. So when anybody asks me about what the market is going to do, that's what I try to. The first thing that comes out of my mouth is that it depends on what part of the
What
market
sector?
you're thinking
Yeah,
about.
yeah.
Yeah.
And just the complicating factor, I think, is the speed that information travels at these days and how investors can be almost instantaneously brought up to speed on any particular sub issue they want to think or talk about. Uh, I was surprised by the half point move by the Fed last week, and
Hmm.
even more surprised by the muted response kind of immediately thereafter. And it was only Friday that we saw the huge melt up, and that was on a triple witching day. I forgot to mention that last week,
Yeah.
and so that was kind of shocking to me. And now we see more of a back and forth kind of thing, and the election is now in focus, and there's not another Fed meeting until November and such and
Hmm.
such. So yeah, people are like, well, what do we do now? Well, nobody knows, and that's where we are. I'm gonna sit back and watch mode for probably 2.5 months here myself. Anyway, that's my comment to Dan is that wherever you're thinking about investing, that part of the market is that's the information that's important to you or anybody in particular, not you yourself, Dan, or me, Dave, but whoever as an investor.
Hmm.
So I don't know what to think about anymore. I'm just going to sit back and watch
That's it.
and
You're
move
not
with the
alone.
flow. Go with the flow.
Try to dodge the torpedo.
Yeah, yeah,
Well,
definitely, election coming up, uncertainty there. So a lot of uncertainty, I would say. So yeah, I would expect volatility. You guys, good points. I'd expect volatility to increase as we get, to that November, and then things will get a lot more clear post-election, I would think. So, thanks, Dan. Thanks, Dave. Anyone
Thank you.
else? Yeah. All right. Well, there's no earnings stuff, this week, so I think things are just starting to roll out. It's JP Morgan. I was looking at them. Usually right around the first earnings calls. Typically, that's October 11th. So still got a little time, but some of the pre-runners coming out, but none of them are confirmed yet. So, and it's like, what was it? I'm verifying. I mean, you guys can try and trade them, but looks like it's still estimated. So nothing we can do there.
Josh, you just mentioned JP Morgan. I
Mhm.
wonder if anybody else has been thinking or noticing in the last few, Jamie Dimon has come out kind of like, I'd say concerned, I think, in several of the last quarterly, before the last few quarterly results that he gave for JPM. And JPM stock, I think, has gone up significantly just before and after. So it's been a good characterization of pre-running as a cyclical kind of event.
Mhm.
yeah, Dave, Jamie, I mean, quarter after quarter is like a broken record, talking about the dark clouds ahead, and, and then they come in and do seemingly just fine.
Yeah. Okay. Well, that's all I had. I'll pass it over to Joe for his analysis. You ready, Joe?
Yeah, Josh,
All right.
good afternoon. Thank you. Thanks for joining, everybody. Let's see here. We'll come back. Well, actually, to have this up, just speaking to the volatility of the markets, and Dan, I think we and Dave, you mentioned the speed, and we've been talking about the speed. I think that's the only thing that's changed in the market is the damn speed. We had a hell of a correction from the middle of July to August 5th, and that was the correction. The one before that was in April. So I think we've had a couple corrections, and the April correction, was a solid 4 to 6 weeker, starting early March, ended April 19th. The more recent one started either July 10th or 17th, pick your date, ended August 5th. So, I think we've had corrections, and I think the market continues to just grind higher because the expectation is that earnings are going to kick ass. And I saw today, I think it was Bank of America talking about expected S&P earnings growth for, between now and 2025 is 18%. And, we pulled up those crazy numbers for the Russell, 2 weeks back. I'll keep trying to track that, but I think that's why, the market now, the election typically doesn't change the markets a whole hell of a lot. If anything, we've talked about, the recent presidential elections have been more of a bottom than anything else for the markets. Taking that indecision out, it just seems to me, I don't know if it's going to be a little bit different this time, because it's hard to get your head around exactly what would happen under Harris administration. So I think that is a little bit more of a wild card. But here, this is just this AAII and just the volatility in that. Just to me is just kind of interesting. Again, I don't put a whole lot into this. There are only, I think, 1,500 people who respond each week. It's when those differences between bullish and bearish get real narrow. That's when I pay attention. That doesn't happen too often, but I found it darn interesting that you had a double-digit move in a week, recently, and this will come out tomorrow, so it'll be interesting to see. In terms of the home page, whenever we get those little yellow boxes, I like to maybe do a little homework on them. And Dan, thanks for your comments on the tweaks on the platform. So we get state ones at 53%, and had one of our colleagues do a little homework for us. So the big picture, so the database is 2007 to current, and obviously the size of the database has grown dramatically. So the percentages can vary a little bit, but these are the years and number of days that the state ones are above 50%. And, it's a whole lot of years. Again, we had a smaller database in the early days. We're at just over 4,000 now. So that's above 50%. And we have just under 4,500 days in the database total. The total number of days above 50% is around 950. So it's about 21% of the time the state ones are north of 50%, 21% of the time. So if we narrow that, and I'm just throwing these up like this because maybe these numbers in years, will equate to something in your mind that I don't, see. So here we are above 60%. And it's, again, database obviously has grown, but above 60%, it's 7% of the time. So, what catches my eye here obviously is 20 and 21. And that 2021 period was kind of consecutive from December of 20 to June of 21. We're not every day, but that was essentially the period where the state ones were above 60%. So, then, and prior to that, we had obviously the financial crisis. And so, you got something coming out of there. And then obviously we had COVID. But, it wasn't until December until we got up into the 60% range where, those 50%ers started in earnest in April of 2020. But we had a follow-up too of a lot of days above 60% in 2021, but they were done by June. And then it was another almost, pick your sector, what have you, but the market essentially topped out, late November to early January, 2021, 2022. So, I think even the state ones by themselves now, and again, the size of the database has grown, worth watching. Are we going to climb up into the 60% range? I kind of think we're going to, unless the election throws everything into haywire, which just can't know at this point, and won't know until the results are in. Which hopefully the results will be in. What do you think, Josh? Maybe sometime in early November.
Yeah.
Goodness knows how long it's going to take to count the darn things. But that's 60%. So 7% of the time we are above 60% in state ones, and then you get to 7 or above 70%, and that's really rarefied air. But it was a very similar time period. Just coming out of COVID, basically. You had January and February of 2021, you were 70%. So, that gave you darn near a year of a very, very strong market. So kind of the point, just I think keeping an eye on that yellow box, see if it continues to grow and, get over 60 and, we'll see how things build from there.
Hey, Joe, question.
Sure, Dave.
Can you go back to that chart?
Yeah.
That spreadsheet?
Yep. Which what would you like?
Okay, so you said it was 7% of the time above 70? Or
No, I'm sorry. I didn't mention the percentage above 70,
Yeah.
less than 1%. Okay. Above 60 is 7%.
above 60 is 7. Okay, so example 2007. Is that when you say above 60 by year, that's you're talking about the whole database?
Yeah, the whole database. What percent of the database? What percent of state ones in the database were above 60%? Where we're 53 now and kind of on a slow, steady climb. Well, at least.
Okay, so like in 2007, is that 5 occurrences?
5 days, exactly. It was only 5
5
days the entire year. So
okay,
this is number of days in the year.
I got you. Okay, thanks for the clarification.
Sure, and again, above 50%, it's 21%. It's 21% of the time. 7% at 60, and then it's just an absolute sliver above 70. But I don't think we're getting there now. But coming out of COVID, the extreme sell-offs, we don't know the secret sauce, that Shook has put together. But we came out of that incredibly depressed state, built on state ones, in both early in late 20 and then early 21.
So how did you calculate the 7% of the time?
We have 4,400, like 4,462, I think is the number of days in the database, and obviously that grows by 1 every day. So I think it's let me see where it was. So just a percentage of days divided by the 4,462.
Oh, okay, by the total database. Yep.
Yeah, so here we are. It was a total of 314 days above 60.
Yeah.
So the 4,462 divided by the 314.
Okay.
So in and of itself, we got a snapshot in time here. We're 53%. We're building a little bit. If we're going to have the election, I think that is really the wild card. If we didn't, I'd be a believer in consistent earnings growth and think that we're, getting above this level, and I think that portends to a good market. So let me go back, and so the next thing I teed up was basically I'll go to the more recent one. Here's the more recent one. So here we are in the time frame of December, when we were above 60% in 2020 and 2021. It was in this period here, okay, where we had a lot of state ones. We had a long way to run in the market. And so, I think generally it portends to strength. So that's the recent period right in here where we were north of 60% of state ones. And then if you go back to 2010, here's where it was as well. Let me see. In 2010, it was, I think in this period here. It was, and it was a smaller database then. So it wasn't we didn't get as much of a run as we did more recently when we got to those higher numbers. But, more recently we were coming out of COVID too.
Is there a correlation in the steepness of the market, the steepness of the trend to the state?
Well, honestly, I think, if you're kind of connecting the dots, I think as Josh was pointing out, you look for the state targets. I mean, the steepness dam for me, you go back to kind of the Bollinger Bands, distance above the moving averages. You get too far above those things, and you got to be looking for pullbacks. And I think, like in the S&P, we talked about 150 to 200 points above, the 20-day moving average. You got to be looking for a pullback. So, to me, it's a question of kind of connecting the dots and using the different measurements that you use. But steepness to me, generally suggests strength, but too far, too fast. You look at those moving average distances and then, look for your pullback and work Fibonacci retracements.
Yeah. Can you send out that Excel spreadsheet?
Yes,
And
definitely will.
Can you put in the percentages that, like the 7%?
Yeah.
For the. Okay.
Yep.
Beautiful. I appreciate it. Thank you.
You're
So,
welcome.
Joe,
So yes, Dave.
yeah, I wanted to comment on your comment about the being out of bounds from some of the range bound metrics that we have, like Bollinger Bands. What's the other one? Some Keltner channels are too. And I was curious as to do you have a preference of which, let's say, moving average to be out of bounds is more critical to watch at, whether it's like the 50, the 250, or like I don't know, a monthly or something? Yeah, sorry, I should turn my phone off. But I typically did like the 50, but I was curious as to what other people might think about. But I've been looking at that a lot lately as to when certain stocks jump out of that range on the upside or the downside, it's either time for a pullback or a bullish trade the other way.
The two moving averages I like, Dave, are the 50 and the 20. I mean, 250 obviously is big too, but that's really just a big time, longer term trend number. But the 50 and 250, or excuse me, the 50 and 20 are the two that I like, and the ones that Josh and I talk about from time to time.
Okay, thanks.
Sure. So let's see. As Josh pointed out, we're coming up on these targets now in the SPX, so it'll be interesting. I wanted to also we hear about the expanding breadth of the market. So here's the one equal weighted S&P ETF, which is doing pretty well. I'm not sure what happened here. Sorry. And we are in the middle of some targets. So you would expect maybe some pause here, but certainly been good breadth in the market. NDX, just sort of a trading range. We did not the leader that it was over the last year and a half. A little bit of a laggard now, but let's see what we got here. We still have lots of time in NDX. So as Josh pointed out, we got some numbers coming, and I think certainly the surprises are still to the upside. News driven. As Josh pointed out, we got inflation Friday. We got kind of looking back core PCE numbers on Thursday. We got jolts. Obviously the market I think is going to be real focused on all the employment stuff. So we got jolts on Tuesday, and then next Friday we got unemployment, and they're Trading Economics is looking for 130 grand on the employment number. And Dan, you had asked also about international, and I agree with Josh 100%. That's why we have those couple broad indices on the home page. You mentioned FXI, but also that Trading Economics site. I mean, there's so much information there about all the global markets. I would just urge you, if you're really doing some homework, that's a great place where you can find a lot of information.
Hey, thanks, Joe.
You're welcome. Let's see. Yeah, not much to add here. You know, Josh knocks this stuff out, you know, beautifully. Obviously, it's a relatively new state one, you know, in the Russell. Dow just up and away, but you know, yeah, up and away, up into the target range. IYT, I thought I'd pull this up in front time to time. Just, you know, it should be a pretty good, you know, pulse of the economy, if you will, and no indication there that there are any problems, you know, in a state one, and, you know, pretty close to, let me just double check. How are we, you know, pretty close to all-time highs in this thing. So, you know, no hint of a recession there, I don't think. FedEx, Josh mentioned that to me last week when this thing, you know, cratered. And I just had to pull this chart up just because charts sometimes are just so darn amazing. Look at that thing crater the way it did. And then, I mean, look, it filled the gap. I mean, it doesn't always happen, but it filled the gap within like a point. I mean, it's just absolutely, you know, mind-blowing to me how the charts work sometimes. You know, despite FedEx falling out of bed, I think the IYT is doing fine. You know, recession, blah, 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 consumer discretionary seems to me like, okay, well, let's check out some of these. And this is the XLY and the components. So it's a pretty good list. A couple of these things have struggled with Starbucks and Nike. But here you are. And, you know, Dan, to your point of, you know, speed in the markets, I mean, this thing is absolutely taken off like a rocket ship. And, you know, whether the impetus of that is lower rates, I don't know what the hell it is. I just know that it's, you know, what a rocket ship. And, you know, here's your sell-off, August 5th. I mean, that's a mean, you know, we did get, you know, 10 to 20% sell-offs depending on what you're looking at, you know, mid-July to August. And it's just, that's where, you know, option volume continues to be steady and grow. I mean, options are such a great tool in this day and age with markets moving as quickly as they do. And this thing banging up against target 3, and after a run like this, you would think you'll get a pause. I didn't want to pull up all the individual charts, but that's a hell of a list. And, you know, some of these retailers, I think I mentioned last week, have just been, you know, mind-blowing in how high they've gone. And I got to, you know, look into them a little bit individually, and I'll pull them up one of these weeks. But, and, you know, Costco's one of those. Let's see, just a couple more. Oh, yeah, a couple of individuals. So, you know, I like to keep an eye on NVIDIA, even though, as I said before, I don't think it's an NVIDIA market anymore for sure. But it can't be a bad thing unless it's going to be a bad, you know, state one signal. And I guess we had one, you know, not too long ago. Constructive that NVIDIA is now in state one, and, you know, on average it's 44 days. So that can reverse. And again, I don't think it's a market leader, but I just thought it was kind of interesting that it is now back into state one. A couple more that we've talked about in the past. Just Microsoft, you know, that was a bad state one recently. It's back in and filling, you know, in a range between, you know, the high in July and, you know, the low here. So 4 to 450, it's a range. Nothing wrong with that. I mean, after the run it's at. Google, I think, yeah, Google actually in a bit of a bearish state. And, you know, again, trading range. And that seems to be where, you know, a lot of these Mag 7s are at this point after, you know, tremendous leadership. And then VIX, you know, not really a whole heck of a lot. I just thought I'd pull it up because, you know, I don't think we have in a while. It will be interesting to see if, you know, the VIX, and I haven't gone into the pricing or the term structure of options. Obviously, you know, I would think there's a fairly high premium, for November and December options given the election. I haven't looked at that, but this thing just looks like I don't know what, the markets are okay for now, and they were okay all along here. I mean, this actually, let me back this up a little bit, because we had a pretty good correction in April, and this was the hiccup. That's probably April 19. Yeah, it is. So we got the pretty good low, and this is where we had that decent correction. And it started really out here with some maybe Nvidia had a tough day there. I know some of the techs kind of had a bit of a tough time starting in early March, and this was your period in the VIX. And what do? We get as high as the low 20s from basically 13, 14 range, and that was the bottom of the market. And then this was obviously the bottom of the market too. And so I just thought I'd pull it up, and you guys have all been in the markets a long time. I'm not sure if you see anything in these charts, but that's what I like to do sometimes, just pull them up and let you look at them. And I guess I could be, say less, but anyway, that's the last one I wanted to pull up. So, yeah, fair number of numbers, I guess, on Thursday, Friday, next Tuesday, and then next Friday too. So see what happens. But we're 11%. We've had a hell of a run. We're 11% off the August lows that was 8 weeks ago. So nothing wrong with the markets going sideways. And as Josh pointed out, I think it is October 11th with JP Morgan, and we're right back into earnings. And we have the election laying on top of that this cycle. So we shall see. So, any comments or questions? Happy to take them. Otherwise, thank you for joining as always.
Hey, so Joe, this is Dave. Just a couple of information kind of things before closing here. And I wanted to say something about the NVIDIA trade being kind of one to watch. The Micron announces tonight. Again, this is not a blurb to suggest buying or selling or anything in Micron. But they're a pretty good bellwether for the semiconductor group as a whole, and it's kind of an important thing to watch as far as the AI kind of thesis moves along. Most of the Wall Street guys they think of memory as a commodity, and what drives the volume of the commodity for memory? Is it the laptop cycle, the smartphone cycle, AI cycle, if you will? I just because I follow that group pretty closely, I just want to let everybody know that some of those let's say vendors in that space are not all memories created equally, if you will. Not all processors are created equally. Every computer needs a processor, memory, I/O, and operating system to run it. Those are the components of any computer, right? So as computing goes, so goes some of those subsectors thereof. So I'm watching Micron to see what they say. By the way, the Wall Street doesn't like it when any company goes and invests in itself in the future with capital investments. If you've noticed how the market's turned on Intel, Micron, any company that's building out now, they've downgraded all those stocks. In my opinion, that's a consistent theme that I've seen out of Wall Street analysts. Anytime there's big capital investments, oh well, that's going to harm the bottom line in the next 2 or 3 or 4 or 6 quarters. It definitely does. So they downgrade the stock, and people, investors back away. Well, because they want their money now, not 6 quarters from now, which, in my opinion, is not a great thing. But that's the way our U.S. capitalism works. So you got to go with what it does. So anyway, Micron is. I'll I'll let you know what I think of their review next week, but I think it's going to be an important factor on the upcoming um, reports that we're going to hear from all the Mag 7 who have invested steeply in all that AI buzz, and we'll see how the ROI is on those AI investments, which are hard to track, by the way. So be watching the Microsoft and Apple. You know, Apple's been storming on all this AI buzz, but they haven't released anything yet. But look what the stock is, you know, bring up the Apple chart and just follow the news. And when the news comes out, that's time to go invest in Apple, whether they, you know, not going to offer products for another quarter or two. Follow the news. That's a good stock to follow the news on either way. So anyway, that's what I wanted to say in closing. I'm a little disappointed when a company, a U.S. company, wants to go and, you know, invest in itself, and then they get hit with downgrades from Wall Street. It just like bothers me, but it happens. I don't know. Maybe I'm overreacting to what's happened lately, but it's been quite the theme lately. Any comments on what other people observe or, you know, think about that? It's kind of like a closing question, and maybe it's rhetorical. We'll just wait and see, but you know, we'll
Well,
see.
Dave, I think you know you do have some real expertise in that area, and I appreciate because you do bring this up, you know, pretty much each earnings cycle about MU, and I know I appreciate it. You know, it's interesting. You go back 2 quarters, you got a gap up back in March, you know, and it wasn't too long before, you know, we had the sell-off, you know, into the April 19th lows. So I don't know whether there was something, and then, you know, the more recent quarter, you know, obviously it was heading south and then really got crushed. So I don't follow it closely enough to have any idea, you know, why the reactions were so drastically different. But
well, let me just point something out there. In my opinion, and this is just my opinion, but that's when NVIDIA announced that they had a technical glitch in their Blackwell, you know, next chip out, and they had to delay it for a couple of quarters. And NVIDIA's been selling everything they can make, but if they can't make it, they can't sell it. So I think that's where the near term, you know, sell-off came from, because people thought, well, maybe they won't be able to put something out for longer, and we'll sell off until it does. So I think that's my personal observation of why the downdraft there. So again, it's the news. News drives stocks in the short term, like in a week or a couple of days, and then the longer term too. So
indeed, it does. Well, it'll be interesting.
It's hard to play the news in the short term if you don't use options. So that's why I use options in the short term for news items.
Right. And you know, we've got this thing obviously in the state 8 going into earnings, and it so far that signal has been ineffective. But thanks for pointing out that number's tonight. Be interested to see. I don't. Yeah, not sure what's expected and all that jazz, but yeah, we'll keep an eye on it. So thank you. All right, Josh, I guess.
Yep. Yeah, thanks, Jim. Thanks, Dave. We'll wrap it up here, and all you Tampa residents, stay safe with that hurricane coming, tomorrow, tonight. So hope everyone stays safe,
right.
and yeah, we'll do it again next week. Thank you all.
Thank you, everybody.
Thanks, guys.
Thank you.